All right, let's dive into a really fascinating story coming out of the Indian banking sector, South Indian Bank. What we've got here is a classic case study, really. It's a story of an incredible strategic turnaround that's just smashed head-on into a completely unexpected management crisis. We're going to break down the analysis from early 2021 all the way to early 2026 to figure out what's really going on.
And this slide, it just perfectly captures the central conflict, the paradox at the heart of this whole thing. On one hand, you have the fundamental win. I mean, as of January 2026, the bank was putting up its best numbers in over a decade. But then, look over to the right, you've got the sentiment crisis. A crisis so deep it led to a massive, and I mean massive, 19% sell-off in a single day. So the big question is, right, how can a bank be at the top of its game and get hit with a market reaction like that? Let's unpack it.
So to really get this story, we have to start with the bull case. Let's first take a look at the anatomy of what has been, by all accounts, a genuinely successful operational turnaround. This is the foundation for everything.
Okay, so what's really striking here is the sheer scale of the balance sheet cleanup. Gross non-performing assets, or NPAs, that's basically the bank's bad loans. And just look at this trend. From 2021 to 2026, it's just been hammered down. We're talking from a high of over 7% all the way down to just 2.67%. And listen, this wasn't some slow, gradual improvement. No, this was an aggressive, almost surgical cleanup of all that old legacy stress during this new professionalization era.
And this number right here shows you just how incredible the result of that effort was. The net NPA, that's what's left after the bank is provisioned for bad loans, is at a pristine 0.45% as of the third quarter of fiscal year 26. That is a massive 163 basis point improvement year on year. It's a multi-year high for their asset quality, and it really shows their quality credit strategy is working.
So how'd they pull this off? Well, it came down to a very deliberate strategic pivot. As you can see in this portfolio mix, they shifted away from those big, sometimes risky corporate loans. Instead, they really doubled down on more granular, high-yielding retail areas, with gold loans now making up that pretty significant 22% slice of the entire loan book.
And what's really key here is how well they executed on that pivot. Just look at the growth in gold loan volume on this graph, a staggering 26% year on year. This is more than just a new revenue stream. It's become a high-growth, defensive moat for the bank, kind of shielding them from credit cycles and really powering their Vision 2026 goals. Okay, so the fundamentals look solid. The turnaround is the real deal. So now let's flip to the other side of this paradox and see exactly how this all snowballed into a full-blown sentiment crisis, totally overshadowing all that fantastic work.
And here was the catalyst, a complete shocker of an announcement on January 29, 2026. And the irony? It came on the very same day the bank released its record-breaking Q3 results. The MD and CEO, PR Seshadri, the guy who was the architect of this whole turnaround, announced he was not seeking reappointment. Just like that, this single event created an immediate 8-month policy vacuum and completely flipped the script on the investment thesis overnight.
And this chart, wow, it just lays out the market's verdict in the starkest terms possible. The stock absolutely plummeted, a brutal 19% correction in a single day. What this tells us is that the street is now pricing in some serious keyman risk. And that's a huge deal in any turnaround story, right? Because the CEO isn't just some manager. They're the face, the architect, the driving force behind the whole new strategy. So when they leave, the big fear is that the whole plan stalls out.
Now, beyond the leadership vacuum, there are a few other operational headwinds to think about. While net profit grew a healthy 9%, you can see here that the core net interest income, or NII, only grew about 1.3%. Why? Because the cost of deposits is going up, and that's squeezing their margins. Their CASA ratio, that's the chunk of low-cost current and savings accounts, is sitting around 32%, which kind of lags their peers and makes their cost of funds a bit less competitive.
But it's really important to weigh those risks against the bank's strengths. And one of its biggest strengths is its capital position. As you can see, the capital adequacy ratio is at a very robust 17.84%, which is way above the regulatory requirement. This capital buffer, which got a boost from a rights issue back in 2024, gives them a significant margin of safety and the fuel they need to navigate this whole leadership transition.
So there you have it, a clean balance sheet and strong capital on one side, and a major leadership crisis with some margin pressure on the other. So what's the strategic verdict when you're trying to weigh these powerful opposing forces?
Well, the consequence of all this uncertainty is staring us right in the face in the valuation. This chart compares the price-to-book ratio of South Indian Bank against its peers. At just 0.8 times its book value, it's trading at a really deep discount to Federal Bank and City Union Bank, which are sitting closer to 1.4 and 1.3 times. This gap right here, this is where you can actually quantify the market's anxiety.
So, what does this all boil down to? The core thesis is pretty clear. The bank's operational engine is lean, it's digitally savvy, but this leadership vacuum is the main thing dragging down its valuation. In the short term, you can probably expect the stock to be pretty volatile, just bouncing around until a successor is named. The long-term outlook, though, that's where things get interesting. It could be a potential compounder, a real re-rating candidate, but, and this is a big but, that is completely dependent on getting a credible successor in the door and fast.
So ultimately, the big takeaway from all this is that the heavy lifting of the operational turnaround, it's done. The balance sheet is clean, the strategy is sound. But the investment thesis from here on out hinges entirely on one single massive question. Will getting a new leader unlock all of that fundamental value we just talked about, or is this uncertainty going to stall all of its hard-won progress? That's the question on everyone's mind.